Hey guys, if you haven't noticed, the stock market's gotten absolutely pounded lately. This is unfortunately true. And for many Americans who are probably looking at their 401ks or scratching their head after the last 3 weeks going, this isn't a lot of fun. Is there anything that I can really do about it though right now? Well, there's actually a few things that you can do if you want to be proactive rather than being reactive and watching your stocks just take a beating. So before stocks start going down, like the recent chart here on the S&P 500, you're probably asking yourself, well, Matt, that's great. What options do I really have out there? Well, let me tell you, there's actually 3 hedges, which is basically an insurance to help you with some downside protection in the event that the stock market start to fall like this. So the most common and basic hedge in your portfolio is what's called a covered call. And so when stocks are really good and everybody thinks the stocks are going to keep going, at a certain point you got to say, you know what, this has been a great ride, and at a certain point this ride's going to get off and it's going to start to retrace and go back down. So during that point in time is when you want to start selling call buyers covered calls, meaning you're selling the calls and collecting the premium. And this premium is what's going to provide you some downside protection when the stock starts to fall and retrace, i.e. a covered call. However, if a stock keeps falling down, the downside to selling covered calls is at a certain point you will run out of call premium that you are using to hedge for that downside protection, and it will zero out. And if the stock keeps falling, well, you're out of premium, so you're still going to keep taking a loss. And with that, let me introduce to you a married put. So say you own the stock and you're willing to hold it no matter, even if it goes down or you start to see or forecast that the stock is probably going to go down like it has in the last few weeks. So rather than selling a put, you could actually buy from those put sellers and buy downside protection. And the great thing about buying puts is, depending on the length of the contract, as the stock keeps falling, as long as it's in that contracted window of time, it will continue to go up in premium, and you will take those premium gains and offset your losses while holding the stock, i.e. a married put. So what if there was a way I could buy puts while holding the stock, but not pay the premium, but still have the downside protection? Wonder what I could do with that. Well, I'm glad you asked, because that would be the third hedge, which we call an option collar. And an option collar is just that, a covered call with a married put together. So as the stocks start to gas out and starts coming down, the calls that you just sold, you took that premium and then you bought these puts over here. So as the stocks start falling down, the put premium starts going up, and you'll take that put premium gains to offset or dollar cost average back into your stock. That is a great way to protect the downside with a collar. Well guys, I hope you found this video to be educational as well as informative, and you will probably see a lot of videos out there circulating when the stocks are going down and all of this doom and gloom and the market's going to crash. Just remember, the options or derivatives market was created just for that. It is a wonderful place to buy insurance and hedge for downside protection. A lot of people will tell you, because they lack financial literacy, that options are just speculative and high risk. No, they're not. They were meant for this exact reason, as an insurance hedge. And now that you have some information on it, please continue to learn, educate yourself more in the field of options. I think it's a wonderful thing for anyone out there looking to build and grow their stock account. So that said, thanks for watching. I'll see you guys on the next one.